Hey everyone, this is Mike Del Prete. You're listening to Context. Today I'm joined by Scott Wright from RealTrends Consulting. Hey Scott.
Mike, how are you?
I am awesome. So Scott and I were grabbing a coffee before this, and I jumped in with the question you always don't want to hear during a coffee, which is, hey, do you want to record a podcast? And Scott had nothing to do for the next little bit. So here we are. And really the reason behind that, we were having a really interesting conversation about the brokerage space. So tell everyone a little bit about what you do at RealTrends.
Well, it's an honor to be here, Mike. You know what? It's hard for me to turn down a podcast when we're in beautiful Boulder, and all I need to do is get a little caffeine in me, and I'm ready to go. But at RealTrends, my partner Steve Murray and I, we focus primarily on consulting. We do valuations for various reasons. We're involved in mergers and acquisitions. We do some publishing and some research in general business planning and business consulting.
And all in the residential real estate brokerage space.
Correct.
So
That
all
is
the
correct.
M&A,
Yep.
right?
Yep.
And I think I was asking you this over coffee. I mean, this scale, like in a typical year, how many are we talking? A couple dozen? I mean, how many?
So we do probably in the neighborhood of 200 or so valuations a year. And by the way, these valuations aren't just for M&A. We do valuations for estate and succession planning, death, divorce, stuff like that, partnership disputes, general business planning. There are a myriad of reasons we do valuations, but M&A is, we've always at any given time have between 10 and 20 clients. We mostly are on the sell side, so we represent sellers. And so our job is to go out and find buyers for them. We don't always represent in a brokerage standpoint or as a broker. Sometimes we'll just do generic advising, and they'll just hire us to advise on a transaction they might already be in the midst of.
So you're sitting on tons of interesting data.
Yes.
And I mean, you can't do anything with it, right? You can't turn around and publish this stuff.
Yeah, not, publicly. Not a lot. We use this data internally for our clients. We have this, what we call a brokerage benchmark. And so in the hundreds of valuations we do every year, we also have got some other privileged information to brokerage financials. We coalesce it into this big database. We call it our benchmark. And we use that for our clients to provide them with various operational and financial metrics, see how they're doing relative to their peers. And so we use that internally for consulting, but yeah, there's not a ton we've done with that historically, on a broader scale.
Right. And you personally, you've been at this since 2016?
Yep. I've been with Steve since 2016 and loved every minute of it.
Okay. And Steve's been doing this forever.
40 years.
Wow.
Oh yeah.
All right. So, I mean, you've seen a lot. Is now a good time to be in the brokerage business?
You know what? That's a good question. It's been a grind. 2022 was hard for a lot of brokerage firms, and it's going to be a period of time that's going to really test the resolve. You had a period of time where we went from 6.3 million existing home sales in January of 22 to 4 million existing home sales in December of 22. That's a 36% decline. A lot of brokerage firms, that fell right to the bottom line. So it's been very difficult for a lot of firms. But, like I was telling you at coffee, there's going to be firms that want out of the game, that don't want to do this anymore, that can't do this anymore. But a lot of the stalwarts of this industry, the firms that have been through many downturns in the past, they're licking their chops and they're using this as an opportunity to bolster their own companies and grow their firms. So it's going to be a slow grind over the next several years as we recover from the bottom of this current downturn that we're in. It's going to be difficult for some brokerage firms that have never been through it, that don't understand how to pivot and adjust their financials. But, it's going to be a good opportunity also for a lot of firms to use this as a method of growth, whether it's via acquisitions or to capture some of the consolidation that's going to happen in our industry.
So is it really a tumultuous time? Like there's a lot happening right now, and it is going to settle out in a pretty interesting way?
I believe so. One thing that history has told us, Mike, is when there's significant downturns, it takes us a long time to recover. The last major downturn, was kind of an anomalous one because that was the Great Recession. It was the funny money period where we had the Alt-A, the subprime, the no-doc loans, the cat can get the mortgage type of deal. The previous major downturn from that was the one where we had the similar issue with inflation, where, in 1979, we kind of woke up and inflation was a major problem. The Fed attacked it by raising interest rates. Obviously, raising interest rates has a direct inverse correlation with existing home sales. It affected homeowner affordability. It took 17 years to get from where we were at the beginning of that downturn to the same level. So they were at 4 million existing home sales in 1979. We didn't see 4 million existing home sales again until 1996. And so it took a long time to recover from that. historically, it takes a while to recover from major downturns. We'd like to describe it as a hockey stick recovery. It's not going to be a V bounce like we saw back in 2020. We had the pandemic, the markets went down, we hit that bottom. A few months went by when people were trying to figure out if the world was coming to an end. When the world didn't come to an end, it bounced right back up. And we went into this really strong period in our industry in late 2020 and into 21. But this is not going to be a V bounce. We've had our decline, and it's going to be a slow grind, kind of like a hockey stick shake. That's what we call it. And that slow grind is going to be hard for a lot of agents. It's going to be hard for a lot of brokers, but there's going to be another side of it that's going to utilize this as an opportunity to grow.
So you see so much data. I mean, hundreds and hundreds of brokerage firms. What's going to set apart the winners and the losers?
So what's going to set apart the winners and the losers is their ability to be nimble, their ability to adapt. Obviously, as we work with brokerage firms, we find that the strongest firms are the ones that have got that exceptional culture and that leadership that's able to navigate an environment like this. They're obviously, we're in the finance space. And so a lot of these firms that are going to be successful, number one, know how to manage their finances. They know how to manage their expenses. They know how to manage in a downturn. They know how to rally their team, not only their employees, but their agents. And, they know how to adapt in an environment like this. The firms that are really going to struggle, the ones that, especially the small firms, right? We're finding an area right now of consolidation, especially in the small brokerage firms where you've got agents where, let me give you an example. There's about 120,000 brokerage firms in this country. 70% of them have 10 agents or less. The vast majority of those companies, the owners still list and sell. They kind of backed into owning a brokerage firm, or they thought they can be brokers. They're deciding now in this environment, I don't want to do this anymore. The operational burden is not something I could handle. Given this downturn, I want to go back to what I love. I want to list and sell. We're seeing those small companies that are the ones that are really going to struggle. Some of them are going to be all right, but a lot of them are the ones that are going to be the kind of the sweet spot for acquisitions.
So was this kind of a golden age of acquisitions for the bigger companies to start rolling stuff up?
Yes, we're going to see some significant brokerage consolidation, I believe, over the next few years. We're going to see some M&A on the large side. Every once in a while, we'll see some big deals hit. Some of the major purchasers historically aren't necessarily active right now, but if there's an opportunity that's incredibly synergistic, they still might pull the trigger on something like that. We'll see some interesting ways to do acquisitions on the large side of things, but most of the consolidation we're going to see is going to be on the small side. It's going to be the roll-ins, the tuck-ins, the walkovers, where some of these firms that don't necessarily need to throw out a lot of money are going to be able to grab agents and grow via acquisitions in this period of weakness when some of these smaller firms don't have the capability to thrive in an environment like this.
So it's not so much kind of, the top 20 list of brokers coming together. It's that huge long tail, thousands and thousands. I mean, he's 120,000 brokerages in the US.
Mm-hmm.
It's the bigger folks rolling up those smaller folks.
That's correct. A lot of the transactions we're seeing right now, I'll give you an example. We've got probably 10 transactions we're working on. Most of them are going to be local deals. So it's going to be one local firm buying another, one local larger firm buying a smaller local firm. There's not a ton of activity going on right now on a regional or national perspective. We might see some stuff start to happen as the dust settles. We might see some of these larger buyers come back in and be creative in the way they're making acquisitions. But yeah, definitely, it's going to be consolidation on the smaller end.
Can brokerage be a profitable business?
Absolutely. One thing that's really interesting is one of the things we track in our benchmark is retained company dollar. The taboo word is margin compression, right? Our industry has been experiencing significant margin compression. Actually, it's been a 50-year thing. It's really been 50 years that we've seen retained company dollar go from about 50%, where brokers are keeping 50 cents on the dollar. Now we're in the low teens. We've been trending down. We've been keeping a really close eye on that over the last probably 12 years in our brokerage benchmark that we were talking about earlier. Back in 2012, the average broker in our nation was still keeping over 20 cents on the dollar. They were still keeping about 22%. And just in the last 11 years, we've seen that decline to about the low teens, where the average in our nation is about 13%. But to answer your question, what's interesting is over that 11, 12-year period, the average return on revenue has remained very stable. Even though we've seen retained company dollar go down from about 22% to about 13 or 14%, which is a huge decline. That's difficult to manage to. Brokers in the business of making money. They don't want to lose money. They're small business owners. They're business owners like you and I, and they want to make money. And so they've found a way, even over the last 11, 12 years, to continue to make money and to remain profitable. It's been a lot harder. It's not a high margin business by any means, but they could do it.
How are they doing that? How do you take a margin from 22 to 13% and still make money?
So obviously, most of that's managing what we call below the line. You really have got to make sure you manage your operating expenses. We're finding there's a lot of footprint consolidation for brokerage firms. So they're figuring out, and that's kind of the trend we're in, right? We're in more of a virtual workplace, a high-tech workplace where we don't necessarily need the brick and mortar. So we're seeing a lot of brokers cut their costs on their footprint. Obviously, as you reduce footprint, you're allowed to reduce personnel costs. So we're seeing, and that's the biggest area of spending for brokerage firms is personnel. But really, they're having to manage that below the line and cut their expenses. And obviously, you got to be careful with that. You can't cut expenses and have it materially affect your business, materially affect the services that you provide to the agents at your firm. But that's how it has to happen. You got to cut your expenses. And that's how brokerage firms are doing it. They're being nimble below the line.
Is there anything interesting going on in the brokerage space in terms of tech investment? Are you seeing common threads or themes of where brokerages are spending money on tech, to manage the bottom line or to manage any other parts of the business that flows through in the data that you see?
Yeah, I guess me not being a tech expert in the real estate space, what we're seeing happen now in an environment like this where firms are having to manage below the line and watch their expenses is they're using this as an opportunity to really review the vendor contracts that they have and understand, okay, is what I signed up for a few years ago, am I getting the return that I'm, whether it's, a tech vendor, something they're doing for marketing or lead gen, whatever. What we're telling people as part of what we call a GL scrub, we're telling them, hey, go down your general ledger, understanding what you're spending your money on. You don't have to spend money somewhere, don't do it. Also examine your vendor contracts. Are you getting the return that you thought you would get when you signed up for these vendor contracts? And if not, they're using this as an opportunity to renegotiate them to make sure the value matches what they're paying for, or to find another vendor, another tech platform, another opportunity to make sure they're getting an actual return. This kind of environment is really making brokers focus on understanding if they're getting a return for what they're paying for on the tech side of things. And so it's forcing them to be more efficient in their spending.
Without, naming any specific companies or vendors, are you seeing any common themes across that when the companies that you're advising are going through their general ledger and they're starting to talk to their tech vendors? Are you seeing a lot of themes like, oh wow, seven times out of 10, they're not seeing the value out of this?
We don't get that granular with these folks. Obviously, a big area of spending for a lot of these firms, especially the smaller ones, is lead gen. And so they're really drilling down on a lot of the lead gen that they've been paying for and understanding, are they getting the value? Are they getting the leads? And if they are getting the leads, are these leads being converted at the rates that they were promised to be converted? So we're seeing them really focus on making sure they're getting the value from the lead gen that they've been paying for.
Yeah. Okay. No, that makes sense. Is there anything else in the data that you're seeing where you're seeing like trends or themes? Like what's something out of that that's surprised you over the past 12 months?
I'd say over the last 12 months, what we've seen with a lot of these firms is really them coming to grips with their personnel expenses. That's been a big thing for them. And that's been hard for a lot of companies because the last thing they want to do is let go of people, because this is a people business. And when you're trying to build a firm with a strong culture, and you realize that the quickest way to cut expenses, unfortunately, the fastest way to cut expenses is to make personnel changes. I actually wrote an article about this probably about 6 months ago based with the public trade companies. We saw big news coming out over the last 12 months where there were some big job cuts at Remax headquarters, at Anywhere headquarters, at Compass was cutting your engineers. I mean, it was public news where the fastest way to react to this is personnel. And even the smaller firms, and they got to be careful with that, right? You can't cut too hard and too heavy on the people side of things without adversely affecting your culture, but it's also the fastest way to make sure you manage your expenses, unfortunately. So that's probably been one of the biggest trends that we're seeing on the cost side of things, is really paying attention to your people and what you're spending on people and making sure you're getting the value there while also trying to make sure you can still stay profitable and manage your bottom line.
Mm-hmm. Are we seeing a race to the bottom in terms of agent commission splits? All these new models like EXP, and I had Pratesh from Real on last time. It's all about paying out more of that company dollar to the agents, more of the company dollar to the agents. And those are the fast growing businesses. Are you seeing that put a huge amount of pressure on these brokerages or not?
Absolutely. That's probably the biggest theme in our industry right now is that, and I kind of touched on a little bit with that margin compression. Again, we saw this start 50 years ago. Remax actually was founded 50 years ago. They were kind of the first big low cost company. Keller came 10 years later. But it's really been in the last 15 years or so where we've seen the true like flat fee style companies. We call them the unbundleds, if you will,
Mm.
really start to put a lot of pressure on the margin in this industry. And to give you an example of that, we tracked that. So in the brokerage rankings back in 2013, only 5 of the top 100 largest brokerage companies in this nation were true flat fee style companies. The fees that say they pay their agents 100%. It's a monthly fee or a transaction fee or marketing fee. It's kind of the a la carte, the unbundled model. Last year, 16 of the top 100 brokerage firms were true flat fee companies and 6 of the top 25. And so that's been the biggest area of growth by far in our industry on the brokerage side of things is the flat fee companies. And obviously flat fee companies, their margins are very thin and they need to have scale in order to be profitable. And a lot of these companies have been getting that scale. We've seen a lot of the larger flat fee type companies really capture market share. And in capturing that market share, it's obviously radically affected that decline in retained company dollar. And that's been actually the biggest driver by far in that margin compression, especially over the last 10, 15 years, is the advent of this flat fee model. And it's here to stay, by the way. By the way, there's room for every model. There's still room for graduated commission plan style companies, not as much, but there's still room for those. There's still room for the cap models, but this flat fee model is here to stay. And it's definitely been driving margins down in our industry. It's been driving splits down, and it's a real thing.
So what's your advice to, one of those big incumbents, like, right, Anywhere, Compass, Home Services of America? Their operating expenses are magnitudes higher than these new low fee models, where they're cloud-based. There are no offices. Do you go to those folks? And this is an imaginary conversation, right? But do you go to those folks and say, listen, you got to cut as fast as humanly possible and get that OpEx down so you can survive and thrive? Or do you say, on the other side, no, you're fine. Keep it where it is. We're in a downturn, but when things pick up, having all of these, having higher expenses, but having more people, more offices, that's the key to successful growth. Where are you in that?
Probably somewhere in the middle, Mike. I'd say we're in an era of we're seeing an evolving, if you will, of this industry. It's kind of a bipolar, I'll call it that, evolving of what we're seeing in this industry. We're seeing more and more where you've got your large low-cost retailers on one side, and then the other side, you've got your boutique or niche firms. And, the boutique and niche firms might focus on high-end or, lead gen or certain communities, certain areas, townhomes, condos, whatever. And we're finding less and less, it's harder to recruit in the middle. And a lot of those big companies are kind of in that middle where it's not boutique, it's not the big box, it's not the Walmart versus Nordstrom, and it's getting harder for them to recruit. So they're having to adapt, and they're having to adapt fast. It's that disruption, right? We've heard the word disruption in our industry for a long time in brokerage. And this unbundled model, this flat fee model, is disrupting the way that these bigger companies have done it. So they're needing to adapt in the way that they not only have their compensation plans, but in how they manage their expenses. Now, a lot of those big companies, they are, some of them are franchises, some of them are independents, and it comes down to their culture and the services that they offer as well. And there's always going to be a place for, those traditional style companies, but it is harder for them, and they're having to give. Their splits have gone down. We've got clients who, just 12 years ago, they were keeping 30 cents on the dollar. And today they're only keeping about 18 cents on the dollar. And that's still higher than the average, but that's a huge decline. And they've had to manage that appropriately. And they need to keep an eye on that. And they need to understand what's out there. They need to understand what's attracting their agents, what's pulling their agents away from them, and what are they doing to keep their agents. It's not always about the money. One of the things Steve and I always go out and tell people is if it was only and ever about the money, then you'd all be out of business. If it was only ever about the dollar, but only ever about the money, you'd be out of it, because there's always a cheaper option. And so what's keeping your agents with you? If there's always cheaper options out there, what's keeping your agents with you? Well, it's the brand that you have, for example. There's a lot of brand loyalty still with some of these traditional brands. It's the leadership that you have, the local leadership. It's the culture. And so Obviously, these firms need to make sure that they keep their culture strong, their leadership strong, their services that the agents provide strong, but they also need to be nimble, in how they're managing their companies against the competition.
What I'm hearing out of that is it's really hard to be in the middle.
It is very hard to be in the middle.
And this is not just your opinion. I mean, you're looking at deeply hundreds of brokerages every year.
Oh, yeah.
So it's really hard to be in the middle. On the one side, you have these low fee models. On the other side, you have the, kind of the traditional high service, higher fee models.
That's right.
But being in the middle, not a great place to be.
And this business is all about recruiting. That's the business of residential real estate brokerages, recruiting. And those middle companies are finding it harder and harder to recruit against the companies that know who they are on either side. Again, there is a place for them, and a lot of those companies are going to be okay in the middle, but less and less of them are, and it's harder and harder for them to recruit against those other models, against the prevailing either niche or boutique or the large low cost retailers. It's getting more difficult.
Shifting gears a little bit, I publish a lot of research. Has there been anything that I've published recently that's caused some sort of reaction in you, good or bad?
I love your stuff. I love, when I get my Mike Del Prete emails. I'm a chart guy, so I was, telling you at coffee, my happy space is in front of a spreadsheet as well. I love analysis. I love data. I love spreadsheets. I love visuals. I love the stories that charts tell. I think it's fascinating, especially with some of the information you put out recently with, the trends in our industry and, the trends that we're having on the commission side of things, the trends that we're having on spending, on a lot of the analysis that you have with these publicly traded companies, the iBuyers. Nothing's shocking for me personally, but it's eye-opening. And it's what I like is you make it easy to understand for the average person who may not know how to look at, 10Ks or 13Fs and pull out that data and pull out that information and use it on a day-to-day basis. So, nothing, I love the hard-hitting, honest nature of what you put out there, but what it is reality on the trends that we're seeing on our industry. Because you, like me, use data to drive your analysis and to drive your conclusions. And so I think it's fascinating to see that stuff, and it's important to keep an eye on it.
Mm. So it sounds like I'm curious if I'm missing anything, because you have access to a lot of data that I don't, right? It's private companies, confidential, that can't get put out there. Without being super specific, I guess if you just look at the general trends and themes that we're both seeing, they're fairly aligned?
Yeah, I think so. The data that we have that we use for our clients is really hyper focused on the financial side of things, on managing their business to the bottom line. And, not only do we track financial metrics and operational metrics, we also track agent productivity as well. And how can they use what they're getting from us on that front? We see various trends in how brokerages are spending their money. We see them spend less on occupancy related expenses. We see them spend a little bit less on marketing and advertising, or at least be more efficient on that. We see the areas that they're cutting expenses in order to maintain that bottom line return on revenue number. So those are the kind of trends we're looking at. We have a client, how does what you're doing compare to your regional peers? We're able to input their information, their financials into our model, and then compare them to what their peers are doing. Are they strong or weak in certain areas of their spending? How is their agent productivity compared to their peers? How is their return on revenue compared to their regional peers? And so that's the kind of stuff we're looking at our end in terms of trends. But that margin compression that we're seeing, obviously that's data that's really unique to what we do. A lot of people really can't formally track margin compression. We can look at some of the publicly traded data and come up with some conclusions there, but that margin compression that we're seeing, that's the real, bit of information that we can really kind of keep track on. And we try to publish information on that every once in a while and show the trends there, and we probably need to get that out more. We need to get that out more in terms of what we're seeing on that front.
Aside from margin compression, is there another KPI, out of the 10, 20, 30 you might be tracking that's really surprised you? It's moving quite a bit over the past 12 months?
Not really. Brokerages are having to react fast in order to, that, like we said before, there's that 36% decline in 2022. And for the average brokerage firm that sees their home sales drop by 36%, if they're not managing that appropriately, that's dropping right to the bottom line, and that's devastating for their profitability. A lot of brokerage companies don't have big balance sheets, and they can't afford to underwrite their companies from the cash they have on hand. So they need to react very quickly. And kind of like I said before, personnel is a big area that they've been cutting expenses. Marketing, advertising, those are some areas that they've been really cognizant of cutting. So it's the spending more that we're seeing more than anything that they've been able to react fast to over the last 12 months is to really cut their spending to make sure that they're surviving on the bottom line.
Hmm.
And so it's the spending that's been the,
Yeah.
you know,
So over the past 12 months, it's been a busy 12 months. A lot of stuff's going on. What's something you've learned about this industry?
One of the things that we do at RealTrends is we're involved in some mastermind groups. And so we get the opportunity, the privilege, I'll call it, of working with some of the industry's finest firms. And these are companies that are some of the best, and not only independents, but some of the biggest and best independently owned franchise organizations. And it comes down to the leadership. And we see how these companies not only respond, but hold themselves and react and stay calm in situations like this. So a lot of these companies have been through previous downturns. We've had 5 major downturns over the last 40 years. A lot of these companies have been through them before. How are they holding themselves? How are they getting closer to their people? How are they responding? And the thing that I've learned the most is good leaders are able to rally the troops, not only in good times, but in bad times as well. And they're able to be the calm force in their markets, right? I once heard somebody say, I think it was actually Nick Bailey at the Remax conference. He made a comment to a group of people. I think it might have been at one of his presentations where he said, there's no such thing as a good market or a bad market. It's the market we're in and what you do about it. And what I find is these leaders that I'm working with in these mastermind groups is they don't let the fact that we might be in a bad market, they don't panic.
Mm.
And they respond appropriately and they make the appropriate moves within their company, to manage to their own bottom line, but also use this as an opportunity to be that voice of reason for other agents that they're trying to recruit, for companies that they might be trying to roll in and acquisitions that they're trying to make. So I've really seen some great leadership over the last 12 months and a time that's been tough. It's been a tough last 12 months. And it's fun to see the cream rise to the top and seeing these leaders and how they operate and how they stay calm in markets like we're in today.
Right. Comes down to leadership.
Comes down to leadership.
Not something you can track on a spreadsheet.
Right.
Or put in a chart.
Right.
To my dismay.
That's right.
But it's a people business.
Yeah.
And it all comes down to the leadership. And what came up for me when you were talking there is reminds me of one of my favorite phrases. You can't control the cards you're dealt, just how you play the hand.
That's exactly right.
Yeah, it's obsessing less about, oh my God, we're in a bad market, the sky is falling, and this is the market we're in. What do we do? How do we react to this?
That's exactly right.
And that's where strong leadership comes in. Okay, great. Well, this has been an awesome chat. Any final thoughts you want to leave our listeners with?
One of the things we're going to see over the next several years is a consolidation. We talked a little bit about consolidation. We're not only seeing that on the brokerage front, we're seeing on the agent front as well. This next few years, if we have that hockey stick type recovery that I've been talking about, that slow grind where once we finally hit that bottom, which we think we're at about that bottom, that 4 million existing home sales mark, I don't see us going much lower than that if we do. That low single-digit growth is going to be hard for that kind of bottom tier of agents and that bottom tier of brokerages. On the agent front, we track that actually. RealTrends does the agent rankings, and we're seeing agent consolidation. I think the numbers were last year 6.6% of the agents did 17% of the transactions and 28% of the volume. We're going to continue to see the top agents and top teams capture market share. We're going to see that lower tier of agents, the group of agents that were that are either doing real estate part-time or that are struggling to grind, they're going to leave the industry. So we're going to see consolidation on that front. And just like that, we're going to see brokerage consolidation as well. We're going to see firms, with all the bad stuff attacking us from all angles. One of the things I told a group that I was giving a presentation to the other day, hey, who really wants to run a business in the residential brokerage industry right now? And there's going to be a lot of no's, but that's going to create a lot of opportunity for the yeses. We talked about that before. There's going to be some tremendous opportunity for consolidation, some tremendous opportunity for growth. One of my favorite quotes from Warren Buffett is, I get afraid when others are brave and brave when others are afraid. And there's going to be a lot of fear out there in the industry as we recover from that major downturn that we've had. But there's going to be a lot of opportunity. I once heard him say, when there's blood on the streets, that's when I get out my checkbook. I don't think there's blood on the streets now, But use this as an opportunity. If you're a broker owner out there, use this as an opportunity to not only get closer to your people internally, but to get out there in your marketplace and find out who's struggling. And use this as an opportunity to partner up with them or to acquire them or to give them a soft landing, if you will, to not only grow your company, but to consolidate your marketplace and be kind of that leader in your market, being that go-to voice of reason. When you have all the talking heads talking about the sky is falling, you're the one that can go to the smaller broker owner in your market or the agent that's looking for a place to land and be kind of that calm presence for them. And so use this as an opportunity to not only manage your own company to the bottom line, but use this as an opportunity to potentially consolidate. And there's going to be some good opportunities out there. If you're looking to grow via acquisitions, there's some great opportunities for acquisitions. This industry ebbs and flows. Listen, it's a volatile industry. It's a cyclical industry. We've seen downturns, forever. These aren't going to be the last downturns we see. Right. And there's going to be some tremendous opportunity. Now, obviously, the big thing that needs to be talked about, and probably a future podcast for you, is how is this litigation going to affect our industry? And based on some of the news we've seen in the last couple of weeks, there's some big things that need to be talked about. How's that going to affect commissions in our industry? How's that going to affect operations in our industry? How's that going to affect training, coaching, what we do, how we manage? So there's some ways you're going to need to pivot and adapt with some big things coming down the pipeline. And there you go. There's your next podcast is, gosh, how is this litigation going to affect our industry?
Yeah.
And we could speculate a lot, right? But there's some things that have been coming down the pipeline on the news that's going to be radical potentially in how it affects brokerages and how they manage to their bottom line, how they train their agents, and how they manage their profitability.
All right.
Fun stuff.
Next time. Scott Wright, RealTrends. Thank you. This has been a lot of fun.
My pleasure, Mike. It was great being with you.
All right. So yeah, Mike Delprete, you're listening to Context. You can check out my website for more podcasts if you enjoyed this, mikedp.com, and we'll talk to you later. Thanks.